Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off here on the SPY daily time frame chart, and then we'll jump on over to the sectors and other intermarket components. First-time viewers, bear with me. I've got a slight congestion going on. I'm sure you can hear it in my voice. Regardless, SPY daily chart, price action, structure, and psychology. PSP, what do we see from that perspective? Certainly a breakout of the balance range here. We've got a new higher high, right? So higher high from here to here, which keeps the daily uptrend intact. It means that we can afford a higher low pullback, ideally respecting the top of the range at 403. We've also got a daily bar that's now closed above the daily 200 SMA. That's the green line. And we're getting fairly close to the overhead resistance trend line and top edge of the weekly expected move. Just to give you an idea of where that trend line is coming from, remember, we've got all-time high, lower high, lower high. This has really been what's keeping us in a weekly downtrend. So it's, I don't want to say do or die time right now for the SPY to get through it, because I do think that we could reasonably see a little bit of a pullback here off of this area of resistance. But over the next coming days or weeks, it's kind of, time to either prove it and break out of this weekly downtrend or roll over and possibly change the daily trend. But as of right now, we are seeing bullish evidence. What other bullish evidence do we see here? Certainly the way that we interacted with the bottom end of the range on Tuesday's session. Let's quickly flip to the hourly chart here and zoom in on this. Notice that we looked underneath and then closed back above. So this was just a lower wick on the daily time frame that we just saw. We never got a daily close underneath the level, indicating that the sellers never stepped on the gas, especially after this hourly momentum bar. If the sellers were going to make something happen, it should have been a 3-bar play, 1, 2, and then 3 for some follow through. It just simply didn't happen. We're not seeing the evidence currently of any stronger selling in this marketplace. And again, that's kept us inside of a daily balance area here, and most importantly, preserved the daily uptrend, giving us a clean higher low on the daily time frame chart. So as long as 394.50 continues to hold, I don't see any reason why this trend would reverse in the blink of an eye. Again, I think it's reasonable that we could expect some pullback off of this zone of resistance up here. The first area we would like to see hold would just be for a break, retest, and possibly go at 403. So 403 will certainly be on my radar. If we fall back down into range, any higher low above 394.50 is acceptable. And if we do just continue higher, be mindful, I don't really think it's wise to be chasing new money longs up here at this area of resistance. But also, if you think about the objective of breaking out of a range, it's usually to double that range, and we've essentially come into that area of resistance, and that target has been fulfilled. So overall, I do think some bullish developments have been made, but playing long after the fact gets a little bit difficult. If we do see follow through, just make sure to use a trailing stop to not get caught in any sort of liquidation break off of a trend line pullback. So that's your SPY daily time frame chart. That's what I'm seeing. A lot of this is bullish evidence, but please just be cautious as you start initiating new money longs towards the highs. Remember, whenever you're playing in an uptrend, you want to buy the higher low pullback or buy the equal high breakout. You don't want to be buying new higher highs. It's possible that you could get continuation, but your risk reward is generally not as good in this situation. So with that being said, let's take a look under the hood and see what we've got from this perspective. These are the market internals. Top right-hand corner's got you covered with a brief tutorial if you've never seen this before. Overall, I want to say that the breadths were very impressive, obviously closing well above 300 million. So some really solid inflows on the day's session. Notice that we have undone the bearish flows from earlier this week, and we've popped it positive on the cumulative volume reads for the week. So inflows are positive. The advanced decline line here obviously making big strides up towards trend zone at the top. Big improvements from what we saw earlier on in today's session, spending some time under the zero line, but very mild under the zero line. And then your ticks, of course, throughout the majority of the week, barring Monday's sell, it was really just sideways. Notice that Tuesday, that day where we were interacting with the low end of the range, again, not seeing any signs of significant selling pressure there, or even here in the volume reads, and the advanced decliner was positive on Tuesday as well. So no major divergences happening underneath the hood. We're not seeing any, big sellers that are there that are, is not being reflected in the current price action that we're seeing. And of course, we closed the cumulative build and the tick positive on today's session. So internals do check out as being bullish as well. Here's the market profile. If you don't know what this is, again, I've got you covered with a tutorial in the top right-hand corner. Of course, a big concern with the market profile is the structure that was put in on the way higher. Notice that we've got a huge string of single prints, basically. They're not all single prints. We've got some overlap here, little overlap in M and J period as well. But for the most part, right, you would recognize this as thin structure compared to where we had a lot of acceptance prior to the Jerome Powell rally. Now, it doesn't mean that all of this just needs to unwind and we move through it with relative ease. But what I would say is that you want to look at where this volume bump starts. So overall, 40.45 is going to be an area of interest here in your ES futures, because that's where the single prints sort of, at least stop momentarily, and we get a little bit of volume acceptance around that area. Remember that this also would represent, because this, if you were watching intraday, I'll show you on the candlestick chart momentarily, this represents the gap. Right? The gap was essentially above this area right here. We stalled out a little bit before it, and then we just dribbled higher into the close. So I would be mindful of 40.45, right? 40.45 in your futures. If we pull back to that area, that would seemingly be a great place for the market to try to make a turn back in the upward direction if we experience pullback in the first place at all. The other thing, of course, that we could point out here, which is more of a market profile nuance, is that we do have spike rules in place, right? Obviously, with a close like this, we've got a spike here. If we open in the spike, expect two-sided trade. You will learn something about the market as you cross through the high here or the base of the spike there. And just remember that you've got single prints underneath, so thin structure through here should move through it relatively quickly, as opposed to slow grind through it. If we open above the spike, remember that means the market should auction higher to try to find new sellers at some higher price, and opening underneath the spike here is the most bearish outcome, especially noting that we've got more thin structure underneath. We would just look for some downside. So spike rules will be in play. Use your prior high of day and that 40.45 area that we just identified here based on the single prints. To go back to the candlestick charts, let me show you on the SPY hourly, right? This is where we got a little bit of hang up. See that overlap of the lower wick here and the upper wick there? That essentially is where we're seeing that slight overlap and lack of single prints on the market profile that I was just showing you. And once again, that's 403, which on the daily chart, we will remember as the gap from back here. So hopefully everything's coming together to make a nice, pretty picture. So what we were talking about in market profile was this, which is exactly what we talked about from a structural perspective as well, also being these prior highs for a possible break and retest. So 403 is a very important area of interest for me, at least, as we head into the remainder of the week. What do we see here from a, I was going to say structural, but sector perspective? How did we perform? So who was leading, who was losing, and where was the weight? Leading the pack today was the XLK, which, as we know, is the heaviest weighted sector. That is a big risk on look. Fantastic to see that at the top of the pack. At the bottom of the barrel is the XLE for the energy sector, the only red name on the board as measured from today's open. Remember that is D for defensive, so that checks out as being bullish all the way down at the bottom of the barrel. Heavyweight sectors, we already covered the XLK, the heaviest of them all, up 5.07%. The XLF for the financial sector, second heaviest weight that we're watching, up 1.85%. Definitely skewed down towards the bottom. The XLV, healthcare sector, third in our lineup, second by market cap, was up 2.24%. Overall, a very bullish day across the board. What I'm most impressed about, and we'll see just in a moment on the ratio grid, is where the XLY fell, consumer discretionary, up towards the top of the list. Let's check in on the structure and just see how the trends are continuing to unfold here. XLK didn't quite make it all the way out of the balance area, but notice it still looks incredibly bullish, right? No breakdown of the bottom end of the balance here, threatening, or, possibly threatening isn't the right vocabulary word for this, but looking like it wants to break out, right? That, threatening has more of a negative connotation, but looking like it wants to break out to close this gap overhead and at least test that 200 SMA. And that, of course, would give us the higher high here in the XLK, keeping us in a firm uptrend. This is looking really good here, not getting any breakdown, no acceptance from the sellers in that lower wick, and a great bullish response on today's session, of course, based on some of the comments from Jerome Powell, which, again, we'll get to momentarily. Just as a quick, preview, he started to hint at, hey, we're going to start slowing down. And that means that there's not as much risk for valuation collapse in the tech sector with those higher rates, right? So everything is adding up here as a bullish data point in the XLK. If we do pull back off the top of the range, you would just want to see a higher low, at least above the midpoint of this range here. And just based on a quick eyeball test, right, that's going to be somewhere around 132.50. 132.50, as long as we put in a higher low above that, checks out as being bullish here in the XLK, even if we see a little bit of sell-off on tomorrow's session. XLC, let's move through the remainder of the sectors a little bit quicker, especially with this voice I've got going on. XLC, very impressed. Breakout of the balance range here strikes me as a bullish data point. You want to look for continuation. Next overhead target is much closer to 53. You might get a little hang up here, but 53 is where the breakdown came from, and I would look for that on upside. Any pullbacks, just want to see a higher low above 50.75. Next up is the XLY, where I was most impressed on a relative basis, right? Just looking at the percentages here, up towards the top of our list, still inside of the balance range though, right? So it's got to prove itself. It's got to get up and over 148.85, but a first step is getting over that 143, which, as we remember, was actually providing resistance in here. We were concerned with the look of getting consolidation underneath. We've certainly made a step in the right direction, getting above 143. You do not want to see this back down underneath. Steps in the right direction, but ideally, this is a breakout over 148.85 to continue to fuel a rally higher in your S&P 500. Next up, utilities. Oops, sorry, we skipped one, but there's utilities. Here we go. This is D for defensive. We don't want it leading the charge here. On a relative basis, it was towards the top of the list, so not ideal. I'd love to see this cool off, but remember, does the market ever give us exactly what we want to see? Not really. As long as it's not first up in the list, and as long as we don't have the XLK at the bottom of the barrel here, I wouldn't be overly concerned with it, but I just want to keep it on your radar that this should not be the first one to come in here and start pressing new highs, right? Let this lag, let this cool off, let the work be done in the heavyweight risk-on sectors, and utilities, take a chill pill. You're not really listening to us. You gave us that beautiful higher low. I mean, the chart structure looks great. If you're just looking at structure, great. But knowing that it's a defensive sector, not ideal for your S&P 500. Real estate is up next. And with the comments made about rates, no surprise that we moved higher here in real estate. Just watching for continuation over 39. Such a lightweight sector. Not going to do a whole lot to make or break your marketplace. XLB, materials, what's happening here? Same idea, right? Well, I suppose not the same idea in terms of the structure, but same ideas, and this is really lightweight sector, not going to make or break your SPY itself, but looking for continuation out of this balance range here. You could think of this as a weekly bull flag, breaking out, look for that overhead target at 84.20. So slight bullish pressure, but again, not going to make or break us. Only concerned with the XLB if we start cracking into this gap down below, which does not look like a risk as of right now. XLV, the healthcare sector, the second heaviest weighted sector by market cap for your S&P 500. Very important to be keeping tabs on what's going on here. Really impressive, break retest of this prior high here and here. Rally, closed the gap, didn't even really stop or hang up here or here, closed strongly above. Really impressed with what's going on in the XLV. This does strike me as a fairly bullish data point for your S&P 500. Remembering the overall range right here, if this is truly a look below and fail on something like a monthly time frame chart, the target has to be 142. So continue to watch for upside in your XLV. Even if we pull back, it's okay. We can find the higher low because essentially today we did produce that higher high, and the uptrend on the daily is still very much intact. So bullish evidence here. Next up, XLP, consumer staples. This is D for defensive. On a relative basis, it's down towards the bottom of our list, but nonetheless, the structure is bullish. We're coming into resistance here, as well as from a prior top in here. So I would be mindful that the XLP could slow down here. So I'll put an S for slow down, and that would be ideal, remembering again that this is D for defensive. Let's see this lag, and let's see your XLY continue to outperform and break out over that 148.85 level that we had been discussing prior. Next up is the XLF, what's going on in financials. Certainly a similar look to the materials chart, coming into this area of resistance and just breaking out, right? So we had this as possibly a weekly bull flag, breaking out over that. It's starting, it doesn't feel extended because we've got this consolidation right here. The sellers had their opportunity. There was some profit taking going on in there. So I'm not concerned with this being overextended, but just remember that if this does pull back, then it's really up to that XLK, XLY to continue to pull the weight forward and higher if the financials start to, I don't want to say crumble, but at least just lag here towards this area of resistance that we know about, right? So if this comes back down into range tomorrow, if it starts playing around underneath 35.75, the market will remain bullish, but we've got to see the performance still coming through in the tech sector and the consumer discretionary sector. Next up, XLI industrials, just like financials, same idea at least. There's your sort of range of resistance. Remember that this move has really carried a lot of the market rally that we've seen so far. So breaking out over it without a meaningful pullback via price, it's really just consolidation via time. Same idea as what we just discussed in financials. This is a much lighter weight sector. It's only about 8% of your S&P 500, but regardless, because it's done so much work here, if this does decide to cool off, we've got to see the passing of the baton as we've been referencing it over the past couple videos into the XLK, XLY, and the XLV has to continue to outperform as well. Last but not least, the energy sector down at the very bottom of the barrel, the only red sad bar on our screens. This looks great, right? We don't want to see this breaking out of this consolidation for like a weekly or monthly bull flag. As long as it stays in the range here, checks out as playing nicely and giving us what we want to see. Remembering again, one last time, this is D for defensive. Let's take a look at some of our ratio grids. If you're not familiar with the ratio grids, I've got a tutorial on how you can set these things up in the top right-hand corner. That's one thing I've always got for you. It's a tutorial on what all of this is, how to set it up. I've got you covered. Top 4 are our risk on sectors. Notice that all risk on sectors except, well, I should say half. Let me take that statement back. Let me walk it back just a little bit. So positive move here in the XLK, negative move here in the XLV, negative move here in the XLF. However, positive look in your XLY. Remember that this is where we need to start to see the strength coming in. The XLF has done its job. The XLV has done its job. We need to see the strength start coming through the technology sector as well as the consumer discretionary sector. I'm certainly not making the argument that this is like a really solid looking chart. There's a lot of improvement that needs to be done down here, but obviously as you're ticking higher, it's at least keeping things at best neutral, right? Instead of a continued bearish look, which is of course bullish for your S&P 500. As long as this can continue its slow little grind and recovery in the upward direction, a better look for your S&P. Remember that I was saying the industrials did a lot for the most recent rally. You can see that here, starting to cool off and go sideways, just like the XLF, mentioning that both of those look like a risk for pullback. Just a reminder, right? You need to see the improvements here and you need to see the improvements here. So this is just another way of visualizing that. Notice that all of this one I'll be confident in, all of the risk off sectors, the bottom 4 down here, actually saw a downtick, right? So we see a downtick here in consumer staples, downtick in energy, downtick in utilities, and a downtick in real estate. This is looking much better for more of a risk on marketplace, remembering that these represent risk off. So if these are lagging looking, if these don't look good, that's a good thing for your SPY itself. So that's what we've got from that perspective. Let's take a look at our XLY over the XLP for growth versus value. Remember that this is growth, this is value. Just like what we talked about in the XLY itself, so not in a ratio pairing with the XLP, it is perking up a little bit. It's at least going sideways here. Obviously, I'm not trying to make the argument that this is a bullish chart. This is actually not a great look for your S&P 500. However, if we just get down to brass tacks and talk about very nuanced things, this is a higher low, and we did confirm that with a higher low here in your S&P 500. So you want to continue to see that build out that relationship where higher lows constitute higher lows in this pairing. Of course, the one area where you're going to get some hang up is possibly at that resistance trend line. So ideally, for a continued bullish look in the market, you want to see this through the trend line. If we just go sideways and possibly start dribbling lower, that would be another sign of divergence that would not be bullish for your S&P 500. So trying to keep a balanced approach here. This is not the greatest data point, but it's at least trying to hold sideways as we saw massive follow through on today's session. Let's take a look at the dollar. What's going on with the Dixie and the dollar. So some people would classically look at this as a bear flag, looking for that next breakdown, and that would of course be bullish for equities. You could also consider a little bit of a head and shoulders pattern, something that would build out like this, crack your neckline and move lower. Again, that is bullish for equities down here. But one thing that I would at least encourage you to consider is if this just goes sideways here, then no longer is the dollar the primary force that's driving equities higher. We need to start seeing the outperformance in those sectors that we've been discussing. Now, of course, all of these things are, they have some sort of relationship with one another. So the dollar will probably do something as these guys are doing something. So I'm not saying they exist in a vacuum, but if this goes sideways, it really comes down to other components having to influence the S&P 500 in a more strong fashion in the upward direction. All right. Next up, let's take a look at rates. So the TNX signal study is what we'll bring up here. What I primarily want to discuss is, of course, the bullish cross underneath the zero line and the rate of change that we were pointing out in prior videos. It looked like we were threatening a possible move back above zero, but of course, on today's session, after Jerome Powell's comments, just right back down and trending in the downward direction here in our rate of change. So rates are stable, which, as we know, is a good thing and a bullish thing for equities because it means that the XLK can start to outperform. There's not as much pressure with rising rates, which of course have an impact on valuation. Let's take a look at our FedWatch tool. Okay, this is a very interesting look going on over here. So let's pull up our compare. Here we go. So on today's session, after the comments from Jerome Powell, notice that the odds of a 50 basis point rate hike have dramatically increased, right? They went from here to here. What was that? From 60, let's just round off, 65% to nearly 80% on today's session. And the odds of a 75 basis point rate hike have certainly decreased. Another really interesting thing that took place on today's session is that the pace of rate hikes going forward also changed. Remember that in the last video we discussed, there's the possibility here for another 50 basis point rate hike. So we were thinking we would go 50 and then 50 and then 25 and then 25, right? That was kind of the outlook that we had going forward. Well, now we're pricing in a 25 already. So the market's kind of looking at 50, scratch this one, jump right to a 25. If we continue to March of 2023, another 25 basis point rate hike. Look at the probabilities of that increasing, right? May, we hit our terminal rate, which is supposed to be at roughly 5%, 5.25%, slight decrease, but still the favored outcome for May, right? And then June is actually now our first rate cut, right? We go from that 5 and 5.25 to here, 4 3/4, right? And you can see the probability of that actually increased after Jerome Powell's comments on today's session. So overall, the pace is changing. The timeline is that the market is expecting the Fed to pivot sooner, hence in the month of June of 2023, as opposed to later, right? So, and in the past, we were looking at September 23, as our Fed pivot. Why do I bring all of this up? Well, the JOLTS job information looked good this morning, right? This is more of our fundamental take segment. JOLTS looked good. The GDP looked okay, and the NFP was good as well. The market is doing what Jerome Powell wanted to see it do. Of course, we've got continued economic data coming out the remainder of the week. We've got core PCE tomorrow and 8:30 on Friday, the most important stuff, NFP, the unemployment rate, and hourly earnings, right? And as we fast forward a couple more weeks, we get PPI, core PPI, consumer sentiment, and then the mother of all is, of course, CPI, core CPI, right before our December 14th meeting. Again, why do I bring all of this up? Because it's actually showing itself in the market and some of the charts that we can look at, right? So let's go ahead and take a look at our, what do we want to see first? We want to see the TLT, right? I brought this up in a prior video. Notice that the TLT starts to outperform before the, quote unquote dump actually takes place in equities. Here, let's take a look at we're looking for, okay, so the 2000 example is off the table here, but start to outperform, dump, right? And that's just signaling that there is a flight to quote unquote safety in bonds, which have technically, I don't want to call them a safe return, but a safer return than equities, so to speak. We are not seeing that look here in the relative curve to the SPY, right? We are not seeing a flight to safety. And if we add on top of that, right, it gets better. Let's go ahead and add on, where are you? Fed funds rate. We know that historically, when the Fed announces a pivot, that's when the market actually sees some selling. I don't know if it'll be the case this time around, but the red lines represent every time in the past we've seen a pivot from the Fed. Notice that the Fed pivots here, the market moves lower. The Fed pivots here, market moves lower, so on and so forth. You can see this relationship, but again, we don't have the data from the ZB, which is the 30-year bond going back much further, but look at the data. The ZB starts to outperform after the Fed pivot, right? As this sort of downturn takes place. Starts to outperform after the Fed pivot as the downturn starts to take place. Are we seeing any relative strength in bonds ahead of the possible Fed pivot? Absolutely not is the answer to that question. So again, to tie it all back together, we're not seeing the outperformance. We're not seeing fear from investors. We're not seeing the flight to safety into bonds. And it does look good for equities to start rallying and continuing to rally off of the bottom that we've been talking about for the past couple of videos. A very fundamental take that we don't often do on the channel, but we're just not seeing the evidence, at least as of right now in the present day, for a large change in tone and another huge downdraft to come in the market in the next coming, weeks of trade. Let's take a look now at some volatility products now that we've run through probably something that's far too fundamental for the nature of this channel. But what do we see here in the VIX? Sitting right at that 2050 floor from a technical perspective. Remember that this has provided support in the past. So does the VIX pop up and over 2050 again and start to move in the upward direction? Wouldn't seem likely based on what we saw in today's session. But again, we do have a lot of economic data coming out. If any of that economic data is not aligned with what Jerome Powell wants to see, I don't imagine it bodes too well for the market, right? If CPI comes out and it's hotter than the expectation, if we miss CPI, then I imagine that, Jerome Powell essentially walks back what he stated, and all of that, everything that we just looked at here in terms of talking about the pace of rate hikes going forward and the first possible cut, all of that goes back to what we saw in the prior video from Sunday. And that probably does not bode well for equities, right? You see a little bit of a downturn here if CPI comes in hot, because of course the Fed will continue to hold rates higher for longer if the data says to do so. So CPI will be very, very important on December, 13th in the coming weeks here. So overall VIX, as of right now into the remainder of the week, yes, of course this does look good. Let's take a look at the VVIX, which is the volatility of the volatility index. Notice that this is rolling back over instead of the divergence that we had talked about in the Sunday video. This also checks out as being bullish, right? This would indicate that people are comfortable with this being the quote unquote bottom in the short term. This is a local bottom, no doubt about it, based on what we're seeing in the VIX here. People aren't fearful that the market's going to do something like this and just take out all of these lows. So that's that. And then the last volatility product is, of course, our contango versus backwardation, and we are certainly in a strong contango, right? As long as this is moving lower, money managers are seeing that there's more risk in the future, so they're willing to allocate capital in today's session. That is the volatility look. Let's take a look now at our QQQ, what's going on in the NASDAQ 100. QQQ, very similar from a psychology perspective to the SPY itself, as we were just discussing. Notice that we undercut the lows here and rallied back above, closed above the top of this balance, very bullish from that perspective. We are not near, on a relative basis, the SPY, which has closed this gap, right? On a relative basis, the SPY is hanging out up here. It's also above its daily 200 SMA. We don't have that in the QQQ. So overall, looking for some follow through? Yes, absolutely. Noting that we have a consolidation range. If we're going to double that range, that takes us roughly to 300. It would be extended through the top edge of the weekly expected move. However, just remember that markets like to move from expansion to contraction and then once again to expansion, right? So if this represents contraction, we could see some continuation and get some expansion through the top of the weekly expected move. That wouldn't be necessarily off the table. I think the SPY is running into resistance much sooner than your QQQ. So for longs, I would watch the Qs as long as PCE tomorrow morning does not come in hotter than expectation. IWM, what's going on with Russell 2000 and the small caps, lagging the move, being down, or I don't want to say down, but just not moving on a percentage basis nearly as much as the SPY and the Qs. But you can see that we did negate the possibility of a daily trend change. We are still stuck in this range. We did not break down underneath these equal lows. We did not get through the CPI gap, and we've also closed a higher high from here to here. Don't get me wrong, this to here is still a lower high possibility, but the fact that this is no longer the risk of a lower high descending triangle that would look like this, I would say that this is a better look for the IWM as opposed to being more bearish. So currently neutral in the IWM, but if this can get in gear and move to the top of the weekly expected move, that would be a bullish sign, and that would be, remember how we've been saying that this is like a yellow flag for the SPY? It would sort of tone it down from a yellow flag to possibly orange seems a little bit more bearish because it's closer to red, but maybe more like a gray flag, right? It's a gray flag for the market if this just kind of hovers sideways in here, bullish if it starts moving like this, obviously, right? So 190 is your overhead target, top of the weekly expected move, as well as prior resistance from here. Just as a quick snapshot side to side, here are all three on a weekly chart, right? So SPY, you can see it clearly coming into resistance. Qs have some room to run, which is why we're favoring the Qs for longs, just based on the lack of overhead resistance here and the possibility for continuation of that range double. And IWM, you'll notice that it's chopping around still inside of the range, so I would not look to be overly aggressive here. This is neutral. This is where we want to play for longs, and this is where we want to be cautious about new money longs, right? So hopefully that side-by-side comparison is useful. Let's blast through the core list of companies, and I truly mean it here because a lot of these charts actually don't look all that tradable. Apple, the best thing I could recommend here is actually looking for a short setup if we fail to accept over 147.65. Don't forget that Apple is in a downtrend. Highs, lower highs, lower highs. We're back testing this flag breakdown range here. If we roll over, if we show any signs of weakness, you could look for a downside scalp underneath 147.65. I'm not thrilled about playing long into this range. It's just choppy here. The better long in Apple would be, okay, some price acceptance here, high or low, and then we look for a break of the top. So patience will pay in Apple. I'm not seeing the obvious long just yet after the bar bar that we printed on today's session. So this actually complicates things instead of makes it easier. Netflix is going to be very similar, just based on the fact that this is coming off of a double bottom, broke the neckline, good to go. But where are we? We're sitting right at resistance. I would love to see a higher low and then continuation into the remainder of the overhead gap. If it does just continue, please use an intraday stop that you can identify just from a swing perspective, or even if you're looking for a longer day time frame trade, the risk reward up here at the highs is just not as favorable, right? You got to see some sort of, you got to see a risk friendly entry. So intraday, a pullback that holds 303 looks good. Pullback that holds 290, 250 looks good. Then a move higher. If it just breaks into it, you would want to see and try to buy on that pullback here for the higher low and confirmation that we're moving through the gap towards that 332. All right, sticking to the sort of script here and moving faster as opposed to slower. Tesla, again, just like Apple, a little bit complicated here at an area of resistance, especially after completing the look below and fail. So I'm not thrilled about new money longs here. Could it continue? Yes. In that case, you're just looking to retest the lows from there. That's going to be at 205.25. But overall, remember that this trade is now complete. Look below and fail is now complete. It would be ideal for a higher low and then a break off of this resistance, right? You've essentially got a 100% retracement. So waiting for the higher low and then a break. If it does continue, just like Netflix, please try to find an intraday stop loss that you can stick to so your risk reward is not skewed in the wrong direction. For shorts, maybe would consider it here at 205.25, considering that Tesla is in a daily and weekly downtrend. Google is up next, moving and closing into the gap. This does look tradable just based on that information alone. Remember that there's very much, a lack of structure here. So watching for some follow through into 103. Early morning pullbacks just want to hold this area at $100.10. If we consolidate out sideways, break the prior high of day, boom, off to the races there. If it does pull back, the area of interest I would want to watch is 98.50 in Google. 98.50 is your higher low pullback, which preserves roughly a move to about 50% of that balance range and not giving back any more than that, right? Next up is Meta. What's going on with Zuckerberg's fantasy land, as we've been calling it. Very similar to Tesla, honestly, with the 100% retracement. Netflix as well, right? So if it does move its way into this gap, that's fine. You can trade with a stop somewhere in here, right? It does look more bullish than bearish, obviously, with the large green-bodied bar. But in terms of where you place your stop, it's just not clear yet, so you'd have to wait for some intraday structure. Again, these candles, everybody loves to see them, but it does make trading into the future a little bit more difficult in terms of where to place an actual stop loss when you have a lack of structure like this. So overall, I would just be focused on the overhead gap and where we can establish a stop loss on an intraday pullback early on in tomorrow's session or possibly into the remainder of the week. I would not be bearish in Meta until we crack underneath the lows here at 109.30. Next up is NVIDIA. This does look good just because on the weekly chart, we have a clear bull flag, right? So double bottom on the daily, you could call it that. You could call it a weekly bull flag, whatever you want to call it. You're looking for, again, with a tight intraday stop loss that you can establish some sort of move that gets us to the 200 SMA and prior resistance here at 178.50. I do like the setup that's happening. Again, it doesn't feel as overextended because we're kind of in this consolidation range that was a bull flag. I would not be bearish in NVIDIA unless we get some sort of big upper wick and then fail with a strong daily close underneath 168.50. If that does happen and we print an inverted hammer, maybe something that looks like this, okay, let's see if we can get a higher low, build out this triangle, and then possibly break into the future. If the support trend line breaks, that's a different story. Equal low is on the table closer to 150. Next up is Microsoft. What's going on with Saftey? Big break of the top of the range. Again, very difficult to trade after the fact. Intraday, as we were breaking either the indecisive doji high, if you're breaking this high, if you're really, pushing your luck, breaking this high, that possibly offered an entry. But now that we've closed up here, again, it gets a little bit more difficult to pick out where a stop is. You would want to see higher low pullbacks for a break and retest over 250.75 or 247.50, right? It could be either of those levels. The pullback could look like this, or the pullback could look like this and still be extremely healthy here inside of Microsoft. So these two are the areas of interest. I probably would not advocate for chasing it long up here, possibly looking for a short against the 200 SMA if it does continue and get a little bit extended on the daily time frame, right? If we did something like this and we get a sequence that looks like that. Short here, looking for a pullback, right? Next up, last but not least, the mini beast, we've got Amazon. Hopefully that was quicker than normal. I have no idea what the timing is looking like on the video, but moving right along, here is a range, here is a range, right? Depends on how you want to draw it. I would personally look at this because it has the data of these lows as well. This looks fine, right? This does not look extended to me. This looks tradable based on the information of, again, these prior lows and this upper wick from right here. If we can clear 97, things do look interesting in Amazon for an upswing into 101 and then possibly, working towards this overhead gap. So Amazon does look tradable based on that information. You could call it a daily double bottom and your neckline would be over that upper wick here. So again, 97 is your area of interest. All right, I've got a couple of things to share with you for trade ideas. IP is the first one. This is a really terrible trading stock. But the reason I bring it up, I know you're probably like, what the heck? Why would you even include it in the video? It's really more of a learning example. Watch this cup and handle, okay? Watch the cup and handle and watch the gap overhead. All right, for smaller accounts, this might be something that you want to just trade with equity, right? Just trade the shares outright. You're looking at only a $37 stock. So I don't know, buy a couple hundred shares, see if it does something like this. That would be cool. If not, and it just kind of dribbles sideways there, stop is of course underneath the handle low. Your risk reward isn't great in that situation, so size the position appropriately if that's going to be the strategy that you take to trade IP. But regardless, just a great learning example. Watch the cup and handle, see how it pans out, and that'll tell you something about these types of patterns. Next up is ADM. This is certainly more tradable, right? And what we're looking at here is a very clean, you could also call it a very, sloppy cup and handle like that. But more importantly, I would just look at this as an ascending triangle. It's right at the all-time highs. I believe we included this in the weekly swing trade newsletter. So you're getting kind of a double dip here, but over 98 looks good for blue sky territory. Is bullish here in ADM on the continuation. Hammer candle looked underneath these lows. Sellers did not gain any traction. We closed strong up at the highs, watching for a breakout here in ADM. Next up, we've got QCOM. What's going on with Qualcomm? Same idea, excuse me. Trying not to cough loudly into the mic. Same idea with an area of resistance that's possibly offering a breakout into our breakdown point. Notice that this is where the breakdown came from. If we can clear this resistance here, close to 126.50, 126.50, 127, if we can clear that, there's some room to run. Right, you're looking at 140 as a possible target. And remember that this is still in the consolidation range, building out a bull flag here. So I'm not as worried about something like this being overextended. Obviously everything was up big time, or most, stocks were up big time on today's session. I tried my best to find some things here that are also in a playable situation. So MO, Altria, of course, this is a bit, I don't want to say extended, but 100% retracement of the move, obviously made the move with the market in the upward direction. So I would watch for a pullback and then some sort of break. You could think of it as the possible inverted head and shoulders, right? Something that does this, break of that neckline, which is around 46.50. Gets interesting because if you look off to the left, we've got really thin structure from the breakdown. If we zoom out here, the target would be much closer to 50.50. All right, so decent sized move available here inside of MO if we can crack this neckline over the course of time. I'm not convinced that this is like a day trade for tomorrow, but something that's staying on my radar. All right, that's going to wrap up the video. If you enjoyed it or learned anything new today, let me know down below in the comment section or by giving the video a thumbs up. With that all being said, we will be live tomorrow morning at 8:15 to catch the live market reaction to PCE, and I wish you all a green trading week.